right. Welcome to the show. It is a glorious, beautiful, I don't even know what day it is. I was going to say Sunday.
Mid-September day.
Yeah. Yeah. We're getting ready to have another hot streak come through. I feel old when I start talking about the weather. Should talk about something else.
Yeah, that's okay, though. I don't mind a little Indian summer. Be fantastic.
Yeah. First world problems, but I think it'll be the last day this weekend that we actually get to use the pool. And then I got to close it up.
Oh, yeah.
But no kids here anymore. They're all gone, so nobody's using it.
Well, that's what happens when you're retired. Eventually the kids go.
Yeah, not complaining.
Yeah.
All right, man. What do you got for this week? What's
all right? This week was I mean, I hate to keep saying the crazy weeks. Honestly, there was a little bit that was going on. We'll get to it. The probably the biggest news of the week was the revaluation of jobs from March of 24 to March of 25. The economy did not grow. It grew 911,000. So almost 1 million jobs that the BLS said were created were actually not created. And so that gives the Fed a lot more room to start reducing rates. They were already on track. Everybody already thought they were going to do a rate reduction in September, which is next week. And it's certainly, I mean, I have the odds on the slide here. It's basically 100%. It's just whether or not it's going to be a 25 basis point cut or a 50 basis point cut. And so now the market is factoring all that in. So the market doesn't need to wait until the Fed comes out and says, yes, we're cutting rates. They respond based on what they believe is going to happen going forward. And so that's why you saw the F fund go up this week, for example. And you saw the same thing. We're going to talk about this, but you saw the same thing last September. And last September, on the day that the Fed began the latest rate cutting cycle. So actually last September, the Fed cut 50 basis points, and it was the beginning of it was the end of the increasing rates since 2020. So if we remember, rates had come down for 40 years to just about zero. And then the Fed started raising rates in 2020 and got up to about 5%. And then last September, they began cutting. So that was the beginning of the current rate cutting cycle that we're in. They cut a little bit. It stayed sideways for almost a year. And then now we're doing another cut. But last September, when the Fed actually cut on that meeting, that was the bottom of rates, meaning the Fed cut the Fed funds rate, but the 10-year Treasury bond yield, which is the rate that we really care about, that actually started going up. And I got a whole slide about that, so we'll talk about it. But that was really the big news for the week. So let's just keep on going. So we'll take a look at a couple of economic highlights for the week. We'll talk about the Fed meeting that's coming up next week. The S fund glitch that we talked about last week got resolved, at least the most recent one. We'll take a look at a chart of that. And so now we can go back to using the actual index that the S fund tracks rather than the ETF that also tracks the index that the S fund tracks. Then I have a chart to take a look at how to identify risk reward. And I'm also going to use that to show the direction of the C fund at the moment. Okay, so weekly economic highlights. So we've been talking about this now for, I think, months, and it's been all the same, which is all good. Rates continue lower on all these different Treasury bonds. So every time they have an auction, this week there was a 3-month, 6-month, 3-year, and a 10-year bond auction. All of them sold at lower rates than they had sold at their previous auctions. So the lower the rate is, that's the less interest that we're paying people to buy those Treasury bonds, right? Paying investors to buy those Treasury bonds. So it's less of an increase to the deficit. So the lower we can sell these bonds for, the better off we are. And that's been happening consistently for the past several months. Then we had the big one, right? U.S. economy added 911,000 fewer jobs in the 12 months through March 2025. So from March 2024 to March 2025, 911,000 fewer jobs than was initially reported. It was the largest downward revision since at least 2000, according to the BLS. That was definitely the big one for the week, and we'll get to that again in a minute. But this is what it actually looked like. So this is the change in jobs from a year earlier. Okay. And, as long as you're above zero, you're creating jobs. So that's a good thing. But obviously the market looks at the direction. So the number of jobs that the economy had been created has been declining, which, is not great, but it's not that big a deal. But from March 24 to March 25, what was reported was this orange line. And then when they went back and looked at the numbers and did it's the interim revision, the final revision for that time period isn't going to come out until February next year. The way they do it is pretty crazy, but the interim revision gets very close to what the final is going to be. And, we thought that we were up here in terms of creating jobs, and we're actually down here, right? And this is where we are right now. So way fewer jobs were created than were originally reported. And of course, the market responds to what's reported. And so it's not good for the economy. It's just saying that the economy is rolling over at a faster rate than what we expected. And it means that the Fed is much more likely to cut rates. Then we had the 30-year mortgage rate came down, right? Because all these rates are coming down, and we're seeing it ultimately in the 30-year mortgage rate. So that's good for people that are looking to buy a house. Prices are also coming down. So, if rates come down and prices come down, that's great for people that are looking for houses. No doubt about it. PPI. So this is producer price inflation. This was another big one this week. The PPI is the inflation that the producer feels when they create things for us to buy. So there's two sides of inflation, basically, the side that producers feel and the side that consumers feel. So the producer price inflation came way down. And it's interesting because all of this increase is in anticipation of tariffs. And then this is like tariffs being front run, right? We had a lot of companies buying stuff at the beginning of the year to front run expected tariffs. And then we started having some inflation that theoretically was based on tariffs. And then we had a month of negative, of disinflationary producer, how they felt it. So, the tariff question is still definitely up in the air, but this is a big step in the right direction. That's saying that inflation is not going up. Let's not say it's coming down. Let's just say inflation is not going up. And so if inflation is not going up, then the Fed can switch and look at the employment, which is the second part of their mandate, and say, okay, is employment going up, right? Or is unemployment going up? And if unemployment is going up, then they want to lower rates. So this was a big driver of the odds of a rate cut going up. And the other side of that was the core inflation rate didn't really move. It didn't move at all since last month. And it's basically the same as where it was, this time last year. So there's been some churning in there, but the inflation rate overall, this is month over month. So that 0.3% is pretty standard now across the year. And that basically means that inflation goes up month over month, 0.3. That this is not the inflation number. This is how much it's going up every month. So, 0.3 here, and here, that's 1%, right? So you add all this up, and that's the cumulative inflation that you are feeling as a consumer over the course of that year. It's something that the media doesn't really like to put out, but the cumulative inflation is way more important for us as consumers, because all this is telling you how much every month inflation is getting worse. And then the last one here is jobs. So while inflation is stable to coming down, we had a huge uptick in initial jobless claims. right? It was the biggest one in the past 3 years. So could we get a spike like this and then it trails back and everything's fine? Yes, that's happened over the last couple of years. So 1 month doesn't make a trend, but if we start seeing this number keep ticking up, then the unemployment rate will eventually catch up to that, and it won't take very long. And that's when things get really ugly, when unemployment rate starts ticking up. So this is going to be a big one to watch. But in the short term, it also goes to the idea that the Fed is going to cut rates in September. Okay, so if we actually look at some of the things that go into the meeting next week, the Fed has a dual mandate, right? Stable prices, which means inflation. Their target right now is 2%. Depending on how you look at it, inflation is around 2.7%, which is on a percentage basis quite a bit higher than the 2% that they want. But it's not getting worse at the moment. Then the second side of their mandate is low unemployment. So they have basically one tool. It's interest rates. So when they increase interest rates, it pushes inflation down. But when they increase interest rates, it pushes unemployment up, right? Because if they push up rates, it pushes inflation down, but it also pushes up the interest rate. So it costs more to borrow. They're taking money out of the system, and companies that are already having problems that can't refi at that higher rate tend to lay people off, and that's why when the Fed raises rates, unemployment goes up. So it's like a teeter-totter. If right now inflation is not the problem, then they can focus on maintaining low unemployment, and they do that by decreasing interest rates. So the one side is inflation, right? PPI, which is the producer inflation, and CPI, which is the consumer inflation. You add those together, and that equals basically inflation. And it's stable right now. There's no indication of increased inflation due to tariffs, okay, which is good. It means the Fed can focus on its second mandate, which is unemployment. And we had a spike to a 3-year high in claims. So it's pretty clear the Fed is going to lower rates in September. There's no reason not to. There's all kinds of people, to include the president, clamoring to have the Fed lower rates. So as of Thursday this week, the odds of a Fed rate cut in general were 100%. So 88.8% expect a 25%, 0.25 cut. 11.2% expect a 0.5% cut. And this is a pretty interesting tool. It's CME group. If you look at, if you put in FedWatch, it'll come up with that in Google. And it's a pretty good website that shows the odds pretty much day by day of a Fed rate cut. And so right now there are no odds. The odds of not cutting are zero. The odds of a increase in rates are zero, right? So the whole market, the only question is whether they cut by 25 basis points or 50 basis points.
Just curious, Jerry, with that website, did you go back and see like how many times they were accurate? You know what I mean? Like it was overwhelming that there was going to be a rate cut, and then there was. Like, has it matched up historically? I haven't paid attention to that site, so just curious.
I honestly haven't gone back and looked at it like that. That's
just from a simple, kind of perspective, like how accurate are they? Right? What's their percentage of accuracy? Because, I mean, I think they're right this time. I mean, I think it would be pretty wild if there was no rate cut, right? But be curious anyway. Something to look into.
Yeah, no, I'll go back and take a look at that. This one I thought was really interesting. So on September 18th, 2024, the Fed cut 50 basis points. This was the first rate cut since the March bottom in rates. So clearly the bond market did not agree with the Fed, right? Because on the 18th of September, if the Fed is cutting rates, so this is the 10-year Treasury yield, okay? it peaked back here in May of 23 and had been declining in expectation of the Fed cutting rates. They front load it. And so then everybody is sitting around watching this meeting on September 18th, and the Fed finally says, yep, we're going to cut by 50 basis points. So when they cut, again, the Fed only controls the overnight lending between banks. So the amount that the interest that banks pay each other to kind of balance the books overnight is the Fed funds rate. And that's what the Fed is addressing when we say the Fed is cutting or raising rates. That's the rate that they're doing. The longer term rates are affected by the bond market. So the bond market, in this case, the 10-year bond, peaked back here in May of 23 and had been expecting the Fed to cut rates. And because of that, they're front loading it. So yield is coming down. Then on the day they actually do the cut, it was a big spike to the upside in 10-year yield. And it just kept on going into the beginning of 2025. So where we are right now, and the reason you have this big move down in yield is because everybody knows the Fed is going to cut on Wednesday, September 17th. So is it possible that rates continue down into the middle of next week, and then we get that announcement that everybody knows is coming, and rates go back up? Just like they did, last year. It's certainly possible. So anybody who is sitting around saying, okay, I'm gonna reallocate into the F fund, for example, when the Fed cuts rates, because when rates go down, the F fund goes up. Well, the F fund's already been going up, right? It's front loading the expected rate cut. And so it'll be really interesting to see if this is actually the bottom in rates when the Fed starts cutting. Okay. So last week we talked about this S fund glitch. If you want to know the details, you can take a look at last week's podcast. I don't want to go into all the details again, but last week we had a spike kind of like this. We had a spike in the chart and it went up from, it was like 2,500. It went up to 20,000. It was a way bigger spike than this one was. And what that does is it messes up the data on the chart. So I don't have the chart from last week, but basically you have a line. You end up having what looks like a line, a big spike, and then it came back down and the line continues. So it makes it so the chart is unusable.
I actually took a screenshot. I took a screenshot and I can't find it, and I couldn't show it if I had it. I should have sent it over to you because, I finally got a chance to go in and kind of look at it. And it made the whole thing just flat, right? Because and it just makes it kind of useless. And there was no way to just kind of cut out that date. But thankfully, TradingView went in there. Now I didn't check any of the other platforms because I spend most of my time on TradingView, so I don't know if the other platforms got rid of it, and it didn't show up in the the TSP funds on the actual site. So because it's daily, so it didn't show up. So anyway, it was very interesting. And if they'd have kept it there, well, I don't know if you noticed this. This is actually somebody else pointed this out to me. They didn't just fix the glitch; they actually pointed it to a different index. So if you go in and look at it there, I don't have TradingView open, but when you type in DWCPF, look over to the right, and that's different. You'd have to pull it up to know what I'm talking. But check it out afterwards. And anybody that's listening, so I felt like that was kind of interesting. Is like, it's like a DC something. Like it's a different, definitely a different index.
Symbol.
So they didn't. But they merged it with that one. So when you type in DWCPF, you get the other one. That's what it looks like anyway to me. I mean, at the end of the day, it's working, so that's really all that matters. But I thought that was even kind of interesting. Is like, did the actual DWCPF is that unchangeable because it actually happened? Maybe, right? So that actually happened, and then that throws the chart off that nobody wants to use it. Anyway, I thought this whole thing is kind of interesting as how something like that can happen. And if the powers that be decide not to mess with it, like in the earlier chart, I may put it back on the screen. the that other glitch.
Yeah, it'd be great if they could get rid of this one.
Yeah, because normally what we do is we just go ahead of that, right?
Right. If you pull this chart, to the left, basically, until this line goes away, then this chart gets much bigger on the screen. It gets much more usable. And it was so far back, it was in 2014, so it hasn't really been a problem for me for pulling up charts for the newsletter or the podcast. But when we had one that was, last week, it makes it so everything back here is unusable. But it would be great if they would fix that one in 2014.
Write somebody a letter, Jerry.
It's all the letter writing I've done has always worked well in the past. So yeah, maybe this one will work. All right. So let's take a look at a chart. What I'm going to do is kind of go through some analysis of the C fund. And if you guys like this kind of analysis, you definitely want to take a look at growmytsp.com. I mean, this is kind of the basis of what we use for our models and the way that we keep people on the right side of the market. So if you're concerned about the market right now, and there are plenty of reasons to be concerned, not to say that the market's going to roll over, but if you watch any YouTube or anything like that, there are people that are screaming the market's going to go much higher from here, and there are an equal number of people doing jumping jacks about how the market's getting ready to fall 75%. So if that gives you a lot of anxiety, it's completely understandable, but the technical analysis can really help to kind of help you sleep better at night. So this is a weekly chart of the S&P 500 RC fund. And if you're just looking at the price chart, you don't have any way of knowing whether this down week is going to turn into, a bigger correction. You have no way of knowing if this up week is going to turn into a bigger, rally, right? We had been going sideways for a couple of months. So how can you tell, right? If you're just looking at price and you're not looking at any of the indicators, it's really hard to know which of these weeks matter and which of them don't. So the idea is to be in the stock funds when the stock funds are going up. It's not a day-by-day thing. It's a general trend. And so if you can identify and get some level of comfort that the trend in one direction or the other has begun, then you don't have to worry about it for a while, right? Then you have a point at which if it rolls over and goes against you, then you just do the other thing. So what I used here is just a relative strength and MACD. Okay. So this was the drop from COVID. Okay. This is the 50 line on relative strength. As long as the relative strength is above that 50 line, price is going up. You're good. When you get below the 50 line in relative strength, price is going down. Okay. Nobody has a crystal ball. Nobody knows for sure how long these things go. You can have whipsaws. You can have to get in and out. But for the most part, when on the downside, the red line, when price declines, relative strength gets below 50 and MACD turns negative, the odds are that you are just beginning some kind of downtrend. And then when you get back positive, price is moving up, RSI gets above 50 and MACD turns positive, you're likely in the beginning stages of a longer term rally. So this is kind of the structure that we use, part of it anyway, to make reallocation decisions. So if 2022, for example, we had a big down week, RSI got below 50, MACD had turned negative, and it was the very beginning of this decline in 2022. We had kind of a fake out, right? We had a big up week here. RSI got above 50, MACD got positive, and it didn't stay there very long. It rolled over. Okay. So we were in for a little bit and got out pretty quick. But then it got the same, just these two indicators get you back in for this move higher and this move higher and the move higher now that we're in. So if you like that kind of analysis, definitely check us out at growmytsp.com. And where we are right now, obviously, we're in an uptrend. I mean, you can talk about all kinds of things, but you could talk about a lot of different things on this chart, right? We had a big gap up right here that got us above this prior high, and everything the indicators turned positive on that week. We're in an uptrend. People talk about all kinds of things. There's a lot happening in the economy. We can't take all of it in. That's what the price chart does for us. So again, that's where we are. Questions?
As usual, as always, if you have any questions, put them in the comment section wherever you find this video. If you don't find a comment section, you still want to get us a word, you can send us an email at support@growmytsp.com. The support team will get over to us. If it's a personal question about your personal finances, probably can't touch that. But if it's something general, we'd love to get feedback. We love to get questions because we use them on the podcast. We use them, if you're in the Facebook group, we love getting feedback. So send it our way. Yeah, really holding out for this. It seems like it's like I can't imagine the Fed, all these folks, like the daily turmoil they have to deal with, right? And the rest of us are just sitting around waiting for, and then the news kind of pumps it up too, so it makes it so much anxious and so much anxiety, that I can't. If you're not looking at the market, so some of the things like Jerry just explained with technical analysis got me thinking about it, and I'm going to kind of get on my soapbox a little bit, where we love to talk about all of this stuff because it's it's fun to talk about. It's good to talk about. It's not just fun. Like, it's good to know this information so you don't have your head in the sand. But at the end of the day, if you use some simple technical analysis tools, and we have courses on our site to do it. If you can find it elsewhere too, not just on our site. But if you get these small tools, just a little time invested each week allows you to take amazing control over your finance, your investments at least, right? And how you're investing your money. So you take charge of it instead of kind of sitting there wondering what to do, and nobody can really manage your TSP for you. You have to do it, right? So I just urge everyone to kind of sometimes turn down the noise, right? And stop trying to anticipate what's going to happen and just respond to it. And you've got the tools to do it. So, but I'm also hoping for a rate cut, personally. All right, man. Enough of soapbox. You guys, hope you like what you hear. If you do, share it with your friends. If you don't, share it with them anyway. We'll see you guys later.